Hello and welcome to the Loan Officer Wealth Podcast. I'm your host, Chris Johnstone, and I have an incredible offer for you today. What we've done is we've taken the 10 most profitable methods to grow your mortgage business that we have learned from interviewing the producers on this podcast, many of whom are doing over $100 million in volume per year. And we've packaged them together into a condensed 45-minute training where you get to learn the 10 most successful and profitable activities that you should be running in your mortgage business. Then we show you how to automate those processes with people and systems so that they run and continue to produce loan applications and new partners that want to send you business pre-booked into your calendar without you having to do any cold calls or chasing or really any work. It's a blueprint for you to be able to produce more in your business while actually working less. And you can go get that training today for free at chriswebinar.com. That's chriswebinar.com. So make sure you head over there today, grab that training for free, and make sure that you watch it, because the sooner you get started on implementing these strategies, the sooner you can see results and continue to grow your mortgage business. Thank you again for being here with us for this episode, and enjoy another one on the Loan Officer Wealth Podcast. Hello, everybody. Welcome back to the Loan Officer Wealth Podcast. We are joined with Robinson Smith today, author of the Smith Manoeuvre. And boy, are we in for a treat today. Robinson, thank you so much for being on the show today.
It's a pleasure, Chris. Thank you.
Excellent. So if you are a Canadian, there is a very high likelihood that you have heard of the Smith Manoeuvre. And so I was wondering if we could start by just talking about your background and your history. Like, how did you get involved in the subject and how did you get to be where you are today?
Yeah, sure. Um, I was living and working over in China um, until about 2006. I was there for about 8 years. Um, on the advice of my father, Fraser, I started studying Mandarin at the University of Victoria here, and that took me to eventually an international banking career in Beijing. But after 7, 8 years living there, I figured it was time to leave the smog and congestion and come back to lovely Victoria here. So I did in early 2006, and I started my own financial advisory alongside my father. He had his advisory as well, and so we worked out here out of the same office space for well, I was there for about a dozen years,
Wow.
and then sold my advisory in the middle of 2018 to come out with my book, Master Your Mortgage for Financial Freedom, to get word to Canadian homeowners across the country about this strategy. It's not easy out there, but there is help for a lot of people. So, yeah, that's basically my latter half of life story.
Fantastic. That's amazing. And so the Smith Maneuver itself, like, we may have listeners that don't know what the strategy is. We do have some consumer direct traffic or just, listeners that are listening to the podcast. So can you explain what the Smith Maneuver is, and then traditionally how it's used by wealth management and mortgage professionals to help their clients?
Sure. Well, your listeners will know that conventional wisdom in Canada has been for many, many years. If you get a mortgage, pay it off as fast as you can.
Yep.
Right? Get rid of your house debt, and this can lead to a lot of issues for Canadians. We've got two important goals in our lives. One is to pay out this mortgage, and one is to save for our future, for our retirement. And because of limited resources, this choice of which of these goals we attack first is made for us, not by us, because nobody cares if we don't invest for our future, but someone is going to come knocking on our door if we don't make our mortgage payment. So,
Yes.
this inertia, this belief that we need to get rid of our mortgage leads Canadians to throw money at their mortgage, so that over the course of time, they're eventually paying out their mortgage, but they haven't been able to invest for their future.
Hmm.
And these days, we're reading a lot more about retirees being financially dependent on their children.
Yep.
Retirees having to work in retirement. They're not able to go golfing or visit the grandkids. They have to downsize, have to sign up for a reverse mortgage, all these different things. And that's due to this sequential approach. First attack the mortgage, then we're able to free up the money to invest. So the Smith Maneuver itself is a way for the Canadian homeowner to do both at the same time. A little backstory here: it was developed by my dad Fraser back in the mid '80s. These days, rates, of course, are a big discussion, and we'll remember back in the '80s they were double digits, high double digits. Um, and he put his private clients into it for about 15 years. He wrote his book on it, came out in 2002. And as I mentioned earlier, came back into advising in '05 after, and I joined him in '06. But the strategy really is a way for Canadians to get rid of their mortgage faster, which is what every Canadian homeowner wants to do, plus at the same time start to invest significant sums that are freed up through the strategy that otherwise wouldn't exist. So the benefits that the homeowner sees starting right away is that they're going to be reducing their tax bill. They're going to be able to prepay their mortgage with additional cash that they otherwise wouldn't have on an annual basis with this tax relief. And they're putting money aside each and every month religiously into investments, whether it's stocks, bonds, mutual funds, investment real estate, mixed REITs, ETFs, all these different things qualify for deductible interest, and that's what generates the tax relief. So this strategy has been around for close to 40 years, and you said a lot of Canadians will know about the strategy. I am surprised at how many professionals aren't aware of the strategy: mortgage professionals, investment advisors, etc. Now, granted, we haven't done any we didn't do any marketing on the strategy or my dad's book since 2005 or so. We were quite busy with our own practices, but now hopefully word is getting out to more and more Canadian homeowners and the professionals who are able to assist them.
Excellent. And so from a tactical standpoint, so let's just say there's a mortgage broker out there who's new to the Smith Maneuver. How does it actually work? How, technically, what has to happen in order to implement the Smith Maneuver?
Yeah, it's really, the description is very simple. In the background, there's a lot of moving pieces.
Okay.
But elevator going up to the 4th or 5th floor here. What's required is a readvanceable mortgage, and there's tons of readvanceable mortgages out there, as any mortgage broker will tell you, but they're not all created equal. Some are different with regards to prepayment allowance, a whole bunch of different operation, that sort of thing. So getting the right one for the homeowner is very important. But you need a readvanceable mortgage, because what that allows, as your audience will know, is the homeowner to access the equity as fast as he's creating it. So he's got a mortgage payment he makes each and every month. Okay. Let's say it's $3,000. Now, $1,000 goes to principal, the rest goes to interest. But that $1,000 that reduces the principal is able to be retrieved after that HELOC, which is attached to that amortizing loan portion, increases its limit dollar for dollar. So if my mortgage payment reduces it by $1,000, I can get back at that $1,000. Now, what most Canadians do, they pull that out and they make car payments. They go on vacation, they go on fancy dinners and all this stuff. All they're doing is paying down expensive non-deductible debt on this side of the mortgage and replacing it with expensive non-deductible debt on this side of the mortgage. And they're buying assets which depreciate in value. With the Smith Maneuver, if you invest that with a reasonable expectation of generating income each and every month at $1,000, then you can deduct the interest. And that's what makes it so inexpensive. That's what reduces your tax bill. At the end of the year, you get a tax refund because the CRA is taking their chunk of flesh every 2 weeks off the homeowner's paycheck.
Yep.
But they've taken too much. After you send your return in, they realize they need to send you money back that otherwise you wouldn't have received. And so you take that, you make a prepayment against your mortgage, and you borrow that amount back as well and get it invested. So each year, this process accelerates because your tax deductions get bigger. Your investment portfolio is getting bigger. And because your tax deductions are getting bigger, so are your refunds, and you're speeding up the rate at which you're paying down that mortgage. So it's just using the flow of funds that's already being outlaid to your best advantage. And as you'll notice, it's just using the regular mortgage payment that the homeowner is making anyways.
That's okay.
So that's why it doesn't require any additional cash flow. Now, some listeners will say, well, hold on a sec. I've got a constant mortgage payment that I'm making to pay that down. But now with the Smith Maneuver, I'm borrowing back on that HELOC. That has to get serviced, that interest. And the Smith guy is telling me it doesn't cost any money out of my pocket. How can that be if now I have an additional line of credit balance? Well, again, your listeners will understand, the mortgage brokers, that there's something called the increasing efficiency of the mortgage payment. So that very first month, when I mentioned my principal balance went down 1,000 and I borrowed back 1,000 to invest, the next month 1,003 is reduced on that loan portion. 1,003 is therefore made available on the HELOC. I pull out 1,000 to invest, leaving $3 in that account to service the first month's borrowing. Then it's 1,006, 1,010. So there's an increasing amount left over after I get a constant $1,000 invested to service the increasing interest expense on that line of credit.
That small increase, is that enough to make the full payment on the HELOC side?
Yes.
Interesting.
Yep. So this is, there's what happens when rates go up, when rates go down, right? When interest rates are low, as we had seen until recently, I am able to invest, just sticking with $1,000 there as that example. Let's say rates are lower. I can now invest $1,100 a month and still be able to service the increasing interest expense on that HELOC.
Okay.
Because the rates are low, my tax refunds are a bit smaller each year. But okay, again, I'm able to invest $1,100 a month. Now, when rates go up, as we're seeing now, I don't have $1,100. I maybe don't have $1,000 to invest. Maybe I got $900 to invest. So that's what gets pulled out, and the increasing amount that's remaining in that account that hasn't gone to invest is able to service the interest expense, which has now gone up a little bit.
Got it. Okay, that makes total sense. All right, so we're making a mortgage payment on a mortgage that is also tied to a home equity line of credit.
Yep.
We're reducing the amount of outstanding mortgage balance every month by making our payments. Some goes to principal, some goes to interest. What's left over from the initial payment, we're taking out and we're investing.
Yeah, it's basically whatever that the principal reduction from the regular mortgage payment is, right?
Yep.
Because there's two parts to that, one interest and one principal.
Yep.
Whatever that principal amount is being applied against that non-deductible balance is made available again in real time on that line of credit. So that principal reduction each and every month is what's able to be accessed to put to work.
Very good. And now I'm assuming that's where the financial advisor comes in to help take that money that's being taken out of the home equity line of credit on. Where do you put the money? Where do you invest it? What's the plan for investing?
Yeah, that's right. We may talk about this a bit later, but we're training up financial professionals of all disciplines to become Smith Manoeuvre certified professionals. So the mortgage broker, the SMCP, in other words, the SMCP mortgage broker will advise on which is the best readvanceable for you. Then there's the SMCP investment advisor, who can handle the investing component. There's an SMCP accountant who can do the taxation at the end of the year. There's the SMCP insurance agent who can handle insurance aspects. SMCP realtor. If a broker has a client and they refinance them into a readvanceable mortgage, considering it's a bit less these days, but considering what markets have been doing for so long, there's a good chance there's significant equity in that client's home that they would be able to pull out right away.
Right.
And for the mortgage broker, if their client is interested in investment real estate, well, maybe that $130,000 that's immediately available can go to a down payment on a rental property.
Right.
Which is where things get interesting, because now that homeowner, the broker's client, has the ability to implement the Cashflow Dam accelerator. There are a number of accelerators, but the Cashflow Dam entails using the rental revenues to prepay your own mortgage, then reborrow that same amount to service the rental expenses. Borrowing on that each month from your primary residence HELOC is tax deductible because you're borrowing to invest in your business, which is that rental property. And so this is where we're seeing 25-year amortizations gone in 7, 8, 9 years, because we're prepaying by, what are your rental revenues, $2,000, $3,000 a month. So there's a lot of opportunity for a lot of different professionals here, but it's important that everybody sticks in their lane. The mortgage broker doesn't want to say, hey, I think you should invest in IBM and crypto.
Right. Right.
And the investment advisor is not going to say, hey, I think this mortgage is best for you. Everyone needs to stay in their lane.
Yep.
But it's really comforting for the client, because now they have all these different professionals, accountant, investment advisor, mortgage broker, realtor, who are specifically trained in this strategy, who speak the same language, who know each other because they're all in the same network.
Yep.
And so the homeowner doesn't have to educate their broker and their accountant and their investment advisor, no one who and then don't know each other. Right? So
Right. So you're teams of professionals that have all gone through the same certification. Everybody's got the same terminology. Everybody's got the same value proposition that they can give to the customer. And implementation, everybody knows what to do in order to actually make it work
well,
successfully.
that's right. And it is critically important that you get it set up correctly, but it's
Okay.
also critically important that as you move through life implementing the strategy, you stay on track and you
Right.
don't, go veer off the highway onto a dirt lane and not even know you've done so. And that's what
Right.
these professionals do. They can say, hey, here's how we're going to set it up. Here are your numbers. Here's what you're going to do each month. And we're going to be watching you throughout the years. And we're going to be here if you've got any questions. What happens if you move?
Right.
Right? There's a death in the family, uh, a tree goes through your roof. There's all these different life events that if someone isn't specifically trained in the strategy, they quite likely aren't going to know how to deal with that situation without, messing up the tax deductions or, you know, all these different things. So,
Yep.
so yeah, the network is quite valuable for not only the homeowner who really enjoys the fact that all the professionals know each other, but also for the professionals as a real differentiator for the mortgage broker and the investment advisor to show their client they're not just transactional. They're here to learn something that is of extreme value to the homeowner, and they're able to offer it to their client.
Yeah. And that's, in today's marketplace, especially with database marketing and trying to find that unique value proposition in today's marketplace, because, with online marketing and online rates and all of that, our business is becoming slowly commoditized,
Mm-hmm.
where it is, for a specific type of consumer within the marketplace, there's somewhat of a race to the bottom because we've, in my opinion, done a bad job of educating the consumer. So they're just left with rate as the thing that they're analyzing everybody.
No,
And this gives a fantastic value proposition.
I think you're exactly right there. I mean, I've been doing what I've been doing, since 2006, as I mentioned, and I've been around a lot of mortgage brokers, and I've seen a lot of rate buy downs,
Yeah.
and you know, uh, which is, I think, a race to the bottom.
Yeah.
It gets you business, but do you want to build your business that way, or do you want to build your business by putting one client into one strategy? After 3 months, this client says, "Wow, it's doing what you told me it would do. I'm going to call Joanne, Bill, my brother, my colleague, my union member, right? My co-pilot, my fellow police officers, and I'm going to make sure they all call you because
Yep.
they need to know about this." And that's where you add value as a professional. That's how you generate loyalty and referrals. Um, so being transactional works for some professionals, and they make a very good living, and hats off.
Yep.
But for those who prefer to do business a bit differently, this really is a way to generate that loyalty and referrals. I mean, we never seen anything like it. Back when we were actively advising, we used one mortgage broker, and he was closing between 8 and 12 million a month. He never picked up he was just in the business for maybe a year and a half when he kind of sat down with us and started doing business. Never picked up the phone doing cold calls, never did any marketing. He didn't have time. We were just throwing files at him all day long. I don't think he ever saw his wife, but
Well, well, when you come up with something unique and different that helps people, it's the marketplace responds.
yeah.
So in speaking to the value and bringing that value to the consumer, you mentioned you've got a number of different accelerators. The first one, the Cashflow Dam accelerator,
Right.
which I'm very interested in. So basically, you mentioned taking the excess cash flow that you have from rental properties, taking that and using that to then offset or add additional payments on your core mortgage for your main property, your home. Did I get that right?
Okay. Firstly, it's nothing. It's not about taking your excess rental revenues. It's taking all of your rental revenues.
Okay.
When someone goes out and buys a rental property, Typically what they do is they get all excited. They open up a bank account that they're going to use strictly for this rental property, right? We're
Okay.
speaking proprietorships here. And they find a renter, cross their fingers, hope they're great. First month's check comes in directly into that bank account. Let's call it $3,000.
Okay.
And 3,000, hopefully less, but let's just call it cash flow neutral here. 3,000 in from the renters, 3,000 goes out for expenses because they got a mortgage on that rental property, utilities, whatever they're paying for.
Yep.
So money comes into that bank account, money goes out of that bank account. But with the cash flow dam, the CRA is not concerned what you do with those rental revenues as long as it's proprietorship. It's just like employment income. You can do whatever you want with those rental receipts. So after that $3,000 comes in, instead of going directly to pay expenses on that rental property, the homeowner takes that rental receipts from his renters and he prepays his own mortgage, the house in which he lives, right?
Okay.
So on top of, I'm the guy who owns the rental property. I take 3,000 from my renters. On top of my regular mortgage payment, I got an extra $3,000 to prepay my mortgage, right?
Okay.
And I do this each and every month. But after that $3,000 goes down against that mortgage, the amortizing component, that line of credit limit opens up by $3,000. It's dollar for dollar thing.
Okay.
So that $3,000 now comes out, and now I put it back into my rental property account, and the mortgage lender comes in there and takes the mortgage payment. I pay my utilities, expenses, maintenance from that account. So instead of money in to my rental account and money out to the expenses, money in, run it through my own mortgage, pull it back out, and then pay the expenses. And again, a 25-year mortgage will be gone in well under 10 years. That's a hefty prepayment each and every month.
That it is. And so you're leveraging your cash flow and you're making it do two things in the same month.
Absolutely.
Interesting. Now, I'm assuming in Canada, you can't do that if your rental properties are under an incorporated company. Has to be under personal?
In that instance, there is a way to take advantage of you own a corporation and it owns rental properties, or it does some other sort of business.
Right.
But now we're talking about two legal entities in the eyes of the law and the CRA. And so
yes.
What is my tax position if I pull money out of my corporation and give it to myself, dividend, whatever it is, and then prepay my own mortgage and then put it back in my company?
Right.
This is an example. This is an exercise that the homeowner slash corporation owner would do with their accountant or their investment advisor. Does it make sense to pull money from my corporation, which I don't need for living expenses,
right,
to repay my own mortgage? So the cash flow dam itself applies to a proprietorship rental property or a number of different rental properties, or maybe I've got a home-based business, right? I knit sweaters in my garage and sell them online, that sort of thing. We can do the cash flow dam there as well.
Very cool.
Mm-hmm.
All right. Now, you also mentioned that you have other accelerators as part of the certification process that you're going to walk these advisors through. Can you share a couple more of those?
Yeah, sure. Debt swap, for example. Now, this particular accelerator has shown me more times than any other accelerator how much misunderstanding is out there by financial professionals, financial journalists, and major newspapers. A lot of people say the debt swap is the Smith Manoeuvre. When they talk about the Smith Manoeuvre, they think of the debt swap and vice versa, but it's only an accelerator. But what happens here is after my broker refinances me into readvanceable mortgage, I may have $10,000, $50,000, $100,000 in paid up investments. Maybe let's just call it mutual funds, okay, non-registered account.
Okay.
I've been adding to it over the years and watching it grow. I've been fortunate enough to be able to do that. Now, what I can do is, let's just call it $30,000 of mutual funds that I own. I want to look at taxation, but if it makes sense from a tax perspective, I can redeem that $30,000 of mutual funds for cash. I take that cash, I pay down my non-deductible mortgage debt, and as we know, that $30,000 reduction is going to be made available again on that HELOC, so that limit goes up by 30. I pull that 30K out, and I can buy the exact same investment if I want that I just redeemed 7 days earlier, or I can buy a different investment. What I've done, however, is instead of $500,000 of non-deductible debt, I now have $50,000?
Go with 50. I think it was 40, but it doesn't matter.
Okay. So anyways, with the amount that I debt swapped, I now reduce my bad debt, but I pulled it back, but it's good debt. So my total debt has not changed one penny
Right.
from the week before. Before I did this, I still have the same total debt, but I've got $50,000 less of non-deductible debt and $50,000 of deductible debt, which does really good things to my tax bill and speeds up that compression of that amortization significantly. So that's the debt swap, and that's what a lot of people think the Smith maneuver is, but it's not. Then there's the cash flow diversion. If I've been investing $300 a month into, again, a mutual fund, once I have the right mortgage, I can prepay my mortgage by $300 a month, pull that 300 out, and then get it invested. I'm still investing $300 a month. I haven't changed my cash flow, 300 from my pocket before, but I'm first compressing the amortization of my mortgage and increasing my tax deductions before getting invested. Then there's a drip accelerator. If I've got all these investments, if I'm receiving dividends, I can say, all right, give me the dividends in cash. I'm going to make a prepayment against my mortgage, borrow that same amount back, and then buy the same stock, which is kicking out the dividends or mutual fund, right? And the prime the pump accelerator is kind of what we were talking about earlier. Once you get refied into the right mortgage, if you've got that immediately available credit, 150,000, again, I can prime the pump by improving my financial situation, by buying a rental property, or I can prime the pump on all of this and buy a mutual fund or stock or mix it up a little bit of everything. But it's getting a big chunk invested now as soon as possible, which means it's invested for as long as possible.
Right. Yep.
And not pulling that equity out to buy cars or vacations or fancy clothes.
That's it. It is a big part of becoming wealthy, which is all about the Loan Officer Wealth podcast.
It's understanding what the wealthy, how they behave, and emulating that. The wealthy understand two types of debt very, very clearly. They understand good debt. They understand bad debt. They have they have good debt. They don't have bad debt.
Yeah.
But your average Canadian, they think of the word debt and it's all just one big dark cloud hanging over their head. They're not differentiating that debt can make you wealthy. They just think debt is bad.
Yeah, I couldn't agree more. So I had a conversation about this. So my wife ran a fundraiser at our home last Saturday, which was absolutely incredible. We had roughly 100 people in our backyard. It was phenomenal and a great cause. But I digress. And I had a conversation with somebody, and the topic of conversation about Adele getting a mortgage. So Adele, worth who knows, and I guess got a $50 million mortgage to buy this property. And they're like, why wouldn't she just pay cash? And so it's that whole mentality of you can have that mortgage debt, take that 50 million, invest it in something that's producing more than what your mortgage amount is, and you're making the spread. You're making money on the money.
It's understanding. I guess it's taking time to find someone who can help you understand how you can maximize the efficiency of what you have available to you. Mm-hmm. We're not going to be conjuring up cash or cash flow out of thin air, but there's a way to improve your cash flow, and there's a way to maximize the financial situation that you have in front of you. And by not learning or seeking out knowledge about how to improve your financial situation, you're harming yourself. And lots of Canadians are harming themselves. They're putting their head in the sand because it's scary, it's boring, whatever the case may be. But now with all this going on, we got a lot more Canadians who are pulling their heads out of the sand. I can't afford to do that anymore. Yes. I need to figure out how I can improve my situation. And they're coming across my book. They're seeing YouTube videos of myself or interviews or whatever it is, or they're coming across other strategies, but they're looking for solutions. They're looking for answers because they know they need to take action. And right now, with the current environment that everyone is facing, to be able to provide expertise in the Smith Manoeuvre or some other financial strategy, regardless what it is, if it's going to help people, now is the time to say, hey, I have something that can help you. Absolutely. I have something that can help you.
And that's so important for our listeners, but also the financial advisors. And you mentioned insurance professionals and realtors to be able to go with a plan. Like, we're not just going to help you buy a house. We're not just going to get you a mortgage. We're going to sit with you and give you an advisory team that's going to help you pay your mortgage off in 7 to 10 years and build a nest egg for you and your family at the same time. It's an incredible value proposition that doesn't have to do with rate. It doesn't have to do with anything that can be commoditized by somebody else, because you truly do have that unique proposition in order to actually become an advisor for life.
Yeah. And you mentioned rate. I mean, the discussion from the client now is not about rate, because if they've read my book or been listening to anyone talking about the Smith Maneuver, they know it's about having the right setup. If the right mortgage, if you don't want the right mortgage for this strategy because it's going to cost you an extra $100 a month, then don't do the Smith Maneuver. Have $100 less mortgage payment each month, but recognize that you're missing out on potentially $300,000 in net worth improvement, or with the accelerators, over $1 million 25 years down the road or so. So yeah, so that's pretty much a no-brainer. You know what? I'll find that $100 a month to get the mortgage that allows me to do this. So it takes away the discussion of rate, which takes away their necessity to buy down rate.
That's such a good point. So let's talk a little bit about the advisor side of things. So a mortgage professional comes in, and what type of tools and resources are provided within the certification that are really going to help them make a difference in their clients' lives?
Yeah. We've got a portal for the SMCPs that they get access to. There's tools and tips. Here's what I did when I was an advisor. Here's how I explained the strategy. And, I had probably over a 95% close rate from the advisor perspective.
Right.
But the same applies to a mortgage broker who's explaining the strategy. So there's a lot of material, tools and tips on the portal. There's marketing material. Attach this 1-pager, attach this 3-pager, send it out to your list. Mortgage broker has been in the business any length of time as a Rolodex as long as your arm here. And that is a lot of people that you can get out to and say, hey, here's what I am, here's how I know, and here's how it can potentially help you. Are you interested in a phone call, or do you want more material I can email to you? So there, we've got that stuff available to them. There's access to a private Facebook group where all the SMCPs can get on. And well, I'm running into this challenge with a file, and someone else will, well, I just saw that 3 months ago. Here's how I solved it. Right. It's a very collaborative group, and everybody understands, and everybody who's in it is in it. They're attracted to it because they know it can help people, and they know that's how they're going to build their business. The transactional mortgage brokers, investment advisors, whoever, they're not typically drawn to this network because whenever you're providing value, it takes time. It's an investment that you are making into your client. And if someone is more transactional, if that's how they choose to do their business, and they can do more business slamming mortgages through, then that's fine. But when we get on a webinar with our SMCP mortgage brokers, they'll host it. I'll come on for an hour, and now we've got 40 people, 80 people. There's a webinar coming up from one of my SMCPs in early October, and I think he's got close to 500 people registered for it. So we're going to get on. We're going to talk about the strategy, and that's where the value is added. And this is where the homeowners really start to say, look, thanks for everything you're providing. I'm going to make sure I send everybody to you. So, I digress a bit here, but lots of materials available to the SMCPs. We've got the Smith Man calculator. Within 5 or 10 minutes, you plug your client's information in there and shows the projected net benefits and all that. So lots of good stuff within the network. But the real valuable stuff is being able to team up with other SMCPs, mortgage broker, investment advisor, realtor, and accountant, all these different types of professionals, and start sending referrals around to each other.
Yeah.
An investment advisor who gets a client interested, well, you're going to need a refi. Go talk to Barry. He's an SMCP mortgage broker down the street.
Yep.
So
that's
basically it's replicating the model that we had developed here in Victoria. My dad and I, and the accountant and the mortgage broker and the mortgage conveyancer, we all knew each other, right? Just passed clients around.
That's amazing. And everybody's always looking for that network of people that they can refer. What better referral sources in the mortgage industry than a realtor, a financial planner, and an insurance advisor? I mean, those are the ones that we should be making calls to and booking appointments to. I mean, that's what our company does, but that's not Uh,
Mm.
I've got one other question for you, Robinson.
Sure.
Um, because I am a marketing nerd at heart, um, the Smith maneuver really has been very well documented as far as media coverage. There's been all kinds of major news articles written on it, TV appearances done on it, all kinds of amazing things. And I'm wondering if you have an insight into how, as a business, you were able to go out and create such a big splash in the marketplace about the idea and the Smith maneuver in general.
Well, it was mainly the people around me. Now,
Huh.
you may be a marketing nerd, but I'm not, and I'm not great at it. But well, maybe I am because I'm going to plug my book, right?
Yeah, there
But
you go.
so this Master Your Mortgage for Financial Freedom, I wrote this. I came out with this in November of 2019, and it hit number one in 22 categories on Amazon on launch day.
Wow.
So as far as I'm concerned, that's a phenomenal success. And the reason it got there is because I enlisted what's called a publishing partner,
Okay.
and they advise and assist on all aspects of, okay, you're doing a book release, here's what you need to do, here's all the legwork, here are the contacts, here's the social media, all that stuff.
Okay.
And I still don't fully understand how how it all came together, but it was through the assistance of others, a few key people. And from there, it was just a matter of, I started getting contacted by real estate investment groups, personal finance groups. I was interviewed for the Financial Post a couple times, Globe and Mail, Better Dwelling. So it it really started to come to me. I didn't reach out a whole lot,
Okay. Yeah.
I could have done a lot more of that. But being, financial strategy guy, the marketing side of things is sort of a bit beyond me. But fortunately, um, opportunities came to me more or less. So
Excellent.
I have no marketing tips which could be of value to to anybody here. Um, it really is. It's just inertia,
Yeah.
like everything else. The the ball is on the top of the hill, and you give it a kick, and it starts rolling. And that's what's happened in this instance, and I'm very fortunate for that fact. Uh, but that's happened because there are so many people out there who are searching for answers, as I talked to
Mhm.
earlier, and there's people who are in media or who run groups that recognize this, that here is something that can help. So I'm going to push it out,
Yeah.
right?
Absolutely. Well, providing value and having a phenomenal back end, and then getting it in the hands of the right people. I mean, hiring somebody to do something that you don't know how to do is incredible wisdom, because you're going to get it done right and you're going to get it done quick. So
Yep.
often paying for that acceleration is also a fantastic tip. Well, Robinson, thank you so much for being on the show. Now, how do people find out about the certification? How do people connect with you? What's the best way to reach out? How do people get more information?
Yeah, my email address is robsmith@smithman.net.
Okay.
The website is smithman.net. It would be Smith Maneuver, but no one can spell maneuver. I even mess it up every once in a while. So smithman.net, robsmith@smithman.net, and yeah, we'll just take it from there.
Awesome. Fantastic. Can you plug the book just one more time?
Master Your Mortgage for Financial Freedom.
Fantastic. That is fantastic.
It's sort of designed like my father. So this is my dad's that came out in 2002, and this is mine. You can see mine's a little bigger, so obviously it's better, right? Not how it works.
I think so. And hopefully more pictures for guys like me.
My niece actually did the artwork in my book.
Oh, no way.
Yeah, yeah.
That's fantastic. Well, to all of our listeners, I hope that you've truly enjoyed this episode. Don't forget to hit the like and subscribe button. Hit us up with a 5-star review on iTunes. That certainly helps us get more incredible guests like this on the show. And we are looking forward to seeing you in the next episode. Robinson, again, thank you so much for being on the show.
Absolutely my pleasure, Chris.
Hey, it's Chris. Thank you so much for listening, and I hope that you enjoyed our guest today on the podcast. This is a reminder that we have just finished taking the greatest lessons from all of our guests and packaging them together into a brief online video presentation that's going to teach you the 10 most profitable ways to grow your mortgage business. And then we show you how to automate those processes in your business with people and systems so that you get the results without you having to do the work every day. This is quite literally a blueprint so that you walk into your mortgage business every day with pre-booked appointments with borrowers that want to meet with you and referral partners that want to send you business, so that you are spending your time inside your mortgage business on the highest dollar per hour activities, and you truly become the executive of your business, a true business owner, rather than just somebody who's going to a job every day and making a wage on the way through. This is an absolutely incredibly powerful training for you, and I cannot wait for you to experience it. So head on over to chriswebinar.com. That's chriswebinar.com to get that free training today. Now, if you could do me another favor, if you enjoyed this episode, please head on over to iTunes, search the Loan Officer Wealth Podcast, and give us a 5-star rating and review, really on any podcast platform that you're watching this on. That just 30 seconds of your time goes to help another loan officer in the industry discover this information and really help put their life and their business on track for more success. We are all in this together, and there is more than enough for all of us in the industry. So I would love if you left us that 5-star rating and review. Don't forget to stay tuned for our next episode, and I'll see you then.